think, act, and prosper. You are now tuned into the Money Level Show.
Hello everyone, welcome back to the Money Level Show. Today we're going to talk about how to protect yourself from a stock market crash. So this is one of the biggest fears of a lot of people is
that, hey, I'm going to put my money into the stock market and it's just going to crash, it's going to go down, I'm going to lose everything that I earned, and I don't know what else to do, I don't know how to protect myself, I don't know what to do.
That is a big fear of a lot of people. It was a fear of mine for a while too. And I want to give you guys some practical tips on what you can do to protect yourself from a stock market crash and what I actually do to protect myself from a stock market crash. So today we're going to be using Robinhood. So I could bring up TD Ameritrade, but that seems to be very confusing for a lot of people, and a lot of people are more familiar with Robinhood, especially my audience. And so I'm going to be using Robinhood today for this demonstration. So what causes a market crash? A market crash happens when the interest rates are increasing, the debt is increasing, and then eventually companies are becoming over leveraged in debt. They can't pay back the interest on the debt that they have, and then we begin to see the markets start to slide. So that is kind of how markets tend to go up, because these bubbles are inflated, right? You have a lot of money going into the system, you have a lot of money being borrowed, and people get over leveraged in debt. And so we can see that now in the stock market. A lot of people are borrowing on margin, which is the brokerage loaning money to the investor or the trader to trade and invest. And we've seen that with Wall Street bets. We've seen a lot of people lose a lot of money, and a lot of people gained a lot of money as well. However, this continues to inflate this bubble where you have companies being able to take on more debt, banks are charging higher interest rates on that debt, and then everything seems all fine and dandy until you can't service the debt. So that is kind of how markets generally work. It works in these cycles where then when you have to deleverage the debt, you have to sell off a lot of debt. You have companies that go bankrupt, all the bad companies gets out of there. You have people that go bankrupt, people that lose money, and you have this issue. So this happened in 2000 with the dot-com bubble, where we had a lot of people jumping into tech stocks. Tech stocks went extremely high and they were getting huge gains, and these stocks were getting way overvalued, and then we began to see the market correct itself. And whenever the market corrects, people get fearful. People begin to think doom and gloom. They think that the market is going down. They're going to lose everything forever, and they sell everything. So this is a part of like the market psychology where people are selling everything, right? So that's why Warren Buffett said, be fearful when others are greedy, and be greedy when others are fearful. So whenever people sell off everything, a lot of times the wealthy will come in and buy up everything because they're buying it at a discount, because the people that are selling it off are selling out of fear. So that's kind of how stock markets work, and that's how crashes work, is when a lot of people get fearful and they begin to sell off their stocks at even cheaper and cheaper prices, even if they're losing money. Now, back to the app. How can we protect ourselves? So I'm gonna give you a few different tips here. All right, you all are seeing my Robinhood app. You see I got a few hundred bucks in here. I do not use Robinhood anymore. I told you guys that, why I left Robinhood. And so this is the first way I'm gonna show you guys. So some people, what they do is they will buy treasuries and bonds. So like, for example, Bill. This is a treasury, and pretty much you can see that it's pretty stable. I mean, you know, you're not losing a lot of money. You know, it's only going up pennies. You may gain some, you may not. But some people just hold their money in here because when a market crashes or when a market corrects, they're able to use this money to go and buy up the stocks that are selling off. And so some people put money in these. Another one I would show you is SHI, which I believe is a bond. Yep, so you got the iShares Treasury Bond. So as you can see, you know, this is pretty stable. I mean, right now it's at $86. However, back in September of 2018, that was when we had a big market correction. It was about $82. So you didn't really see any losses, any huge losses in this. And so that is what some people do. They will put their money in here and they will receive like a small dividend, like this pays close to 1% dividend, and they would just let the money sit there. And then when the market crashes or whatever, they can just sell these and then go buy more stocks. So that is one way to protect yourself. All right. let me go ahead and explain another way to protect yourself. So another way to protect yourself would be to, so these are some of the bear market stocks that I'm in. So as you can see, the ProShares SQQQ, this means that it is bearish on the QQQ, it's shorted. So these stocks are $11. However, you look at when there is a bear market and you see how high that is right there on the left side of the screen. You see how high it shot up. This shot up to, over $100. We can look at the 52-week high. You see the 52-week high is $162.15. So this is when March hit and everybody sold off all their stocks. So people sold off. And if you have these, you would have turned a little money into a lot of money. Now, what was it before then? So before then, it was at about, let's see, you had the correction in 2019, went from $40 and shot all the way up to like 200 and something bucks, $222. Then it went down. It was at about $82 and shot up to $162. So those are ways that you can protect yourself from bear markets and from stock market crashes. So let's look at a couple more of those. So you do have the SPXS. This is a bear market stock for the S&P 500. So if you look at this chart, you go to the year chart, you see that the high for this one was about over $200. We can look at it, $288.50 is the 52-week high. And you see right now it's at $33. So people would buy these stocks and they would sit on them, and then when they sit on them, what they would do is just wait for the market to crash. If the market crashes, they're actually gaining some money and they're not losing as much while in that process. And these are pretty cheap. As you can see, the SQQQ is $11. You can see the SPXS is $33. So this is the opposite of bull market. So whenever there's a bear market, this is what these stocks do. You have other ones that are short, like the Dow Jones. So you have SDow, which is another one. This is $11. You look at that yearly chart. Back in May 2019, it went from $12 to $52. Then you look at the 2020, it spiked up to about, 52-week high, $95.94. So those are some other ones that you can look at. This is another one, the UXVY, or UVXY, excuse me on that. This one is $9. And you look at, what was it in March? So in March 2020, when the market hit bottom, it hit 110. It actually hit 135 on that 52-week high. And right now, this is $9.37. So these are all bear market stocks that you can collect and have in your pocket. So if you ever fearful that the market is going to crash, you have these in your pocket, you have these ready, and you're able to, make money off the market. So, and some of them pay dividends, like the SQQQ has a 2.43% dividend. So that's pretty cool, to be able to hold those, because they're not going up in value while the market is going down in value. So there's quite a few of those that you can look into and to be able to hedge yourself. Now, another thing is having puts. So you could do calls. So like, say, for example, if you're in the options trading, you could do calls on these. So like January 20th, 2023, say like you believe there's going to be a market correction by then, and you believe that this is going to go higher than $35. You can buy this for $208 or $2.08, but it's actually 100 shares. So it's going to be $208. You can buy this call for 2023. However, this is pretty risky because we don't know what the market's going to do in between that time. We have our speculation and things like that, but we don't know what the market's going to do in between that time. Now, but you can play that at your own risk. You can also do puts on stocks that you're investing in. So Mark Cuban, what he did in the .com bust was he had a lot of shares in Yahoo, and Yahoo ended up tanking, but he also had a lot of puts on Yahoo where he was able to make a lot of money while the stock was tanking. So he protected himself from the crash. So say like you have your favorite company, let's say your favorite company is Tesla. All right, favorite company, Tesla. It's going to be a market correction. It's going to be a crash. Some people are saying it's going to be a crash in 2021. Let's see. Let's buy a put on Tesla for March 17th, 2023. So on the bear market stocks, you're going to buy a call because you're calling that it's going to go up. You're not calling that it's gonna go down. So for this, let's see, 2023, if you were to do a $200 put on Tesla, that's going to cost you about $1,800. So again, this is very risky because we don't know what's going to happen in between now and March 17th, 2023. But that is a way you can hedge yourself if you're interested in that. All right, and so one more way, I'm gonna give you guys another way that you can actually play this. So let's say you believe the market is gonna crash, you can put trailing stop orders. So trailing stop orders means that once the market crashes a percentage, a certain percentage that you want your order to automatically execute. And these are kind of skepticals because sometimes these don't execute, especially when there's huge amounts of trade volume and huge amounts of people wanting to sell and get out. And sometimes your trade will not execute. So you have to be very careful with this. So what you would do is you would go to the stock, click trade, click sell. You would click up at the top where it says shares, and you would go down to conditional orders. You would click a trailing stop order. So what is the percentage that you are willing to lose on the stock when you want this to trigger an automatic sell? So normally a correction, a healthy correction could be up to about 20%. Some people say 25%. But whenever you're in a huge bear market, like a stock market crash, you're losing about 55%. You're losing about 80%, I believe, in the March of last year, we saw a huge loss in this. So this is kind of what you would do. So you would go, okay, I'm willing to lose 20% of this. So the market price is $14.35. So the initial stop price would be $11.48. I would click continue. And what you could do is good until canceled up to 90 days, which would be May 17th. I would press continue, and then you would click how many shares you want, review, then swipe up to execute the order. So those are some ways you can actually protect yourself and protect your wealth against a stock market crash. So I hope that was very helpful to you guys today. Be sure to hit the like button to subscribe, and I hope that you all have a blessed day. Peace.